Stocks falling again, of course, over these fears. We're closing out now the worst week since the 2008 financial crisis. But what does this mean for you, for your money? Jeff Small is president of Arbor Financial. Jeff, it's great to have you with us. First thing we want to ask is how your clients have been reaching out to you. What questions are they asking? What have you been advising them to do?
Well, our phone's been ringing off the hook, to be honest with you. Everyone's concerned about what's happening in the markets. We've lost $6 trillion in market cap in 6 days, the greatest drop on record in the shortest amount of time. But right now, I think that for clients that don't have a stomach for risk, they should probably be exiting the market. If the coronavirus starts to accelerate or potentially reignite in China now that it's in 59 countries, it's going to put a great restraint on the potential output of GDP, not just domestically, but also globally, probably more globally than domestically, because the economy here is very strong, and we seem to have the virus contained, even though they are testing people as we speak. But if you don't have the stomach for the market volatility at this point, because the stomach is more about headlines today, the market is more about headlines today than it is about actual economic data and statistics.
Where are you going to find safety right now?
Well, there's been a huge exodus of money going into treasuries. That's why rates are compressed to the point to where they are. They're crashing, actually, because the demand for treasuries is very large. So there's been an exodus of money coming out of the markets and flying into treasuries. The historical places people go for safety, though, are in decent corporate bonds and fixed income assets, or cash. That's about their only two options right now.
Right, and the Treasury, the 10-year today already hitting a new low, 1.12. The 2-year is below 1%. That flight to safety, I mean, if this now gets oversubscribed on that end, then where is there really a place to go for anybody?
Well, there really isn't. I mean, it looks like we're setting up for a very abnormal scale of economics, and it kind of reminds me of 2008. Where we had the credit crisis. Now we have the pandemic, the potential pandemic crisis. Even though we're not in a pandemic, it's looking like the virus is expanding. And so commerce will stop, rates will crash. There's not too much the Fed can do to get us out of this with any stimulus. That's why they're not acting, even though Powell spoke this afternoon. His press conference, I thought, was rather benign. But interesting point. The 10 years at 1.15, the discount rate on the money that the Fed lends banks to is around 1.5 to 1.75. So those rates have already inverted. The Fed would have to drop rates 50 to 75 basis points just to re-steepen that curve. And so I don't see them doing that until they see an actual result on where the corona is going to end up going within the next 2 to 4 weeks.
The White House economist Larry Kudlow saying today that investors should think about getting back into the stock market, arguing the coronavirus threat to the U.S. is low. Your take?
Well, we just don't know yet. I think there's merit to that argument, and there's merit against that argument. And so we're basically going to be on what I call the corona roller coaster. If we see the virus rates of infections continue to go up and they don't ascend, the market will become more volatile and there'll be more sell-offs. And there'll be more of a flight to safety. But however, if we get a hold of the virus and we can contain it and minimize the effects of growth in the infection rate, and that starts to decline, then the market will come up. But everybody kind of has to stay vigilant here and do what's best for their own portfolio.
Right, and everyone's risk assessment of their lives and their portfolio, the length of when they want to be and how long they want to be in the market, all very, very different. But the fact that the White House, the administration, is even suggesting that this is an opportunity, to buy because things are a little bit cheaper. I mean, is that something that's prudent here?
No, I really wouldn't say that. 15% off of our peaks from earlier this month, that's not a very big drop at this stage. And, we had a 20% correction the last quarter of 2018, and that was just because the Fed raised rates 3 times. So I'm looking for more downside here. Unless we have very positive news on the virus over the weekend, the global markets and our markets will continue to trend into negative territory.
Okay, and so at this point, the next Fed meeting is also coming into question as to what the Fed will do, what type of action they will take. We've been watching the probability of them actually, taking some action here and saying, we're going to cut interest rates at this next meeting. 75 basis points is what we've been seeing from some banks and what they're trying to push the markets for and the Fed for 25 basis points perhaps at this next meeting in March. Do you think we get that? Do you think we see that in the markets? And what impact at this point will it have?
It's great when the Fed lowers rates. It's always a form of economic stimulus. But lowering rates is not going to cause people to go out and make big purchases and refinance their mortgages and buy new cars when there's a contagion in the economy called a virus like the coronavirus. And so that's not going to force people to do that. So the Fed, their action in lowering rates could be potentially benign. That will be positive until we see the actual virus start to turn the corner here and ascend. The only thing that it would do, the only beneficial thing that it would do is it would enable companies to maybe refinance their debt and lower their outlays because earnings, as you know, are going to be dramatically impacted, specifically this next quarterly earnings that are coming out. And so maybe companies will be able to lower their debt expense. That helps balance sheets. That's a good positive sign the Fed can do in lowering rates, but it won't spur the consumer to spend more money with the threat of a pandemic expanding.
When March rolls around, which is just next week, we're at the end now of February, and these declines continue now to be maybe the new norm. What then will you be advising your clients who rely on you, of course, to keep not only their money safe, but also to grow that money?
Well, we're advising our clients right now to stay in fixed income assets. We are not long in any component of the stock market. We do not lock long positions at this stage with everything that's going on until we see the virus turn.
Is that, I mean, that seems like a deviation. If a lot of investment banks were to take that same positioning and say, you know what, we're going to look for more short-termism rather than these long-term plays that we've seen historically, how much of a shift would that mean for the markets if we were to see more of the larger investing houses out there take that same play?
Well, I mean, I think you've got to be a modernist and not worry about what the investing houses say and the Wall Street cheerleaders say. And I've actually been cracking up as I watch all the financial networks the last 48 hours, and I see the pundits get on there and talk about buying into this and buying into that dip. You should not be buying into this dip. The coronavirus is something that we've never faced before. And had the coronavirus not been here, I might be singing a different tune if the virus wasn't here. I might be saying, hey, it's a 15% dip. Look at Apple. Look at Facebook. Look at Tesla. These are all things that we can get back into at much cheaper prices today. But I think there's a lot more room to the downside unless we have very positive news on the progression of the virus.
Yeah, and what positive news would that look like? What would it sound like?
Well, I think that number one, we see the rate of containment being accelerated, meaning there's less people getting it. The only defense we really have is containment. And when we do a deeper dive into the metric of the virus, what we find is that 17 to 20% of all the infected require a hospital stay. So if you get 100 million people with the virus, you're going to need 17 million to 20 million hospital beds. That would literally overwhelm any country's capacity to take care of its citizenry. The other thing that's kind of scary so far, they're kind of keeping the lid on, is the rate of mortality seems to be fluctuating between 7 to 9%, which is about 700 times more than the actual flu rate of mortality. And so I think it's a very serious situation that we have. And I think there's lots of unknowns and lots of things that they still have to discover about the virus. I'm not trying to panic in viewership, but this is something that everybody should be paying vigilance to.
Yeah, and I do think, it's important. I mean, we talk about these fatality rates. We talk about this in relation to the annual flu season that we usually get. And there's already differing numbers. I mean, you're saying 7%. I've seen something as less than 2%. So the fact that we have all these different pieces of information out there makes it really hard for anybody to figure out kind of what's going on, especially when it comes to these cases being so similar symptom-wise to the average flu or the average cold, which means that maybe we're seeing numbers that are being underreported. We're seeing deaths that might not be properly attributed to this. So to your point, I mean, it is really difficult to kind of figure out, and we're just trying to, I think everyone trying to be on the same page with what is the consensus for even something as significant as a fatality rate at this point.
Yeah. All right, Jeff, we got to leave things there here on the day. Jeff Small, president of Arbor Financial, thanks so much for taking the time as always.
Thanks, guys.
Thanks.
Absolutely.